How did it go from this to this in less than a year? Spot Bitcoin ETFs were supposed to be crypto's breakthrough moment. Wall Street loved them. Retail piled in. Bitcoin hit all-time highs. But now, the same ETFs are bleeding capital. In the next few minutes, you're going to understand exactly why spot crypto ETFs are losing money, what the numbers are telling us, and what the experts say about what's coming next. Let's get into it. In January 2024, the Securities and Exchange Commission finally approved the first wave of spot Bitcoin ETFs in the United States, with players like BlackRock's IBIT, Fidelity's FBTC, and Grayscale's GBTC entering the market. This was seen as a major legitimization of crypto by traditional finance. Within the first month, spot Bitcoin ETFs saw inflows topping $10 billion, with BlackRock's IBIT alone hitting over $15 billion in assets by April 2024. The expectation was these products would bring long-term capital from pensions, hedge funds, and registered investment advisors into crypto markets. And for a short time, they did. Bitcoin even hit a new all-time high of $73,000 in March 2024. Then what happened? Why are spot ETFs losing money now? Let's start with Ethereum. Spot Ethereum ETFs were greenlit in July 2024, but the market response was underwhelming. One glaring issue: you can't stake Ethereum in an ETF. That removes a major incentive for holding it, especially with on-chain staking offering yields between 3.5% and 5%. According to Unchained Crypto, Grayscale's ETHE has seen $2.84 billion in outflows since its launch in July 2024. Bitwise Chief Executive Officer Hunter Horsley publicly admitted that the timing wasn't ideal and that investor appetite wasn't as strong as anticipated. Bitcoin ETFs are not all sunshine either. Yes, spot Bitcoin ETFs had explosive inflows initially, but that trend is reversing. As of April 2025, total net outflows from Grayscale's GBTC have hit $22.78 billion, making it one of the biggest fund hemorrhages in ETF history. The reason? High management fees. GBTC charges 1.5% compared to just 0.25% from competitors like Fidelity and BlackRock. And even though Grayscale recently cut fees, but the damage was already done. Another reason? Profit-taking. After Bitcoin's all-time high in March, institutional players locked in gains, causing ETF net asset values to slip below Bitcoin spot prices. Let's see what experts have to say. According to Hunter Horsley, Bitwise Chief Executive Officer, Ethereum ETFs don't yet reflect the full utility of the asset. Investors who understand Ethereum are looking for staking, yield, and participation in decentralized finance. James Seifert, Bloomberg ETF analyst, said, "The ETF product structure works great for passive exposure, but it doesn't capture the full economic opportunity of crypto. Until staking or lending is integrated, there's a cap on interest." And the ARK Invest Chief Executive Officer Cathie Wood said, "These early outflows are not a death sentence. This is just the market recalibrating. The long-term trend remains upward as more institutions become comfortable with the asset class." So, what does the future hold for spot Bitcoin ETFs? Analysts at JP Morgan have predicted that once ETF providers find ways to integrate staking rewards or launch hybrid fund models, Ethereum ETFs could see a twofold increase in inflows by 2026. Also, fee compression is expected. BlackRock and Fidelity are already in a race to the bottom, and this could trigger a healthier, more competitive ecosystem. Let's not forget the macro lens. If the Federal Reserve begins cutting rates in mid-2025, as some projections suggest, we could see a renewed appetite for risk-on assets like crypto, benefiting ETFs directly. And as regulatory clarity increases with potential stablecoin frameworks and MiCA-style rules in the United States, institutional hesitation may decrease. Now the last thing, what should investors do now? If you're already in a spot crypto ETF, it's time to assess. Are the fees worth the passive exposure? Would direct custody or staking provide more yield? If you're considering investing now, ask yourself, Are you seeking price exposure or full participation in the crypto economy? ETFs offer the former, but not yet the latter. So, to sum it up, Spot Crypto ETFs are bleeding because of timing, structure, and fees. But they're not dead. They're evolving. And the smart money is already watching for version 2.0. If you've invested in one of these ETFs, let us know in the comments what your experience has been. Are you holding, selling, or doubling down? And hey, if you found this deep dive valuable, hit that like button, subscribe for more insights, and ring the bell so you don't miss what's coming next from BrokerCheck. And don't forget to visit BrokerCheck Academy on the link given below for an in-depth read on Spot Crypto ETFs.